Hey, welcome back, subscribers, to my world of stocks. We've got a super fun video for you today because this time we are asking the AI chatbot from xAI, Elon Musk's company, to give us what it thinks are the top 5 best stocks to buy for next year and beyond. And as always, I'm going to share with you my own opinion on each one of these stock picks too. I'll even rank them from best to worst based on that opinion. So smash that like button if you enjoy these more kind of obscure type of videos once in a while. But let's just go ahead and jump straight into this. Now, as you probably know, the chatbot is, of course, called Grok, which the newest version of currently is Grok 4. And I did, however, enable a couple of features when asking our question just to make sure that we get the most thoroughly researched and advanced answer as possible. So I clicked on deep search and I enabled expert thinks hard mode. And here's how I worded the question. So I said, we are currently in October 2025. I want you to give me what you think the top 5 best stocks are for 2026 and beyond at current prices. I am a long-term investor looking for the following attributes: brand strength, reasonable valuation, and future growth potential. Stock 1 should be lower risk, stock 2 should be medium risk, stock 3 should be higher risk, and stocks 4 and 5 should be dividend-focused stocks. Be sure to list the 3 important attributes for each stock: brand, valuation, future growth potential, with 2 to 3 sentences explaining each attribute for that stock. At the end of each stock choice, give a really quick and short explanation or summary for why you categorize it as low, medium, or high risk. That's for stocks 1 to 3, or why it's a good dividend option, stocks 4 and 5. Also, you may only choose one stock from the Magnificent Seven. Do not give me any disclaimers. I already know that this is not financial advice and to do my own due diligence. Just follow my directions exactly. Thanks, and let me know if you have any questions. And by the way, the reason why I worded everything like this is because I just find that if you're not super clear and direct with these AI chatbots, they'll tend to hallucinate and give all kinds of weird answers. And especially for stocks, like they might only give you the most popular and safest options. So that's why I specifically told it to only give us one from the Mag 7. They would probably try to choose all of them. And I also told it to give us a combination of different risk levels and a couple dividend stocks too, so that we would have a little more variety. And here were the results after asking that question. So coming in as the first choice among them, the low risk option, Grok gave us Berkshire Hathaway, ticker symbol BRKB, saying this: for brand strength, Berkshire Hathaway, led by Warren Buffett, commands immense respect in the investment world due to its track record of prudent management and value investing. Its portfolio spans insurance, rail, utilities, and consumer goods, fostering a reputation of resilience and ethical operations. This diversified brand appeals to conservative investors seeking long-term reliability. For reasonable valuation, is at a current price of around $500 with a trailing P of 17, forward P of 22. It offers a balanced entry point for a conglomerate of this scale. Compared to high-growth tech peers, this valuation reflects its steady earnings without overhyping future bets. Market cap of about $1 trillion underscores its size without excessive premiums. For future growth potential, said with holdings in growing sectors like energy and tech via investments, Berkshire is positioned for compound growth through acquisitions and reinvestments. Analysts project steady earnings amid economic recovery, potentially benefiting from interest rate shifts. Its cash reserves of over $344 billion enable opportunistic expansions into emerging markets. And then for the summary, it just says categorized as low risk due to its low beta of 0.77, broad diversification across industries, and history of weathering recessions with minimal volatility. Okay, so I partially agree with this pick here by Grok, and really most of what it says here I think does make sense. For example, I agree that it is fairly low risk given the businesses that they own. They may not be very exciting ones, but they are fairly stable. like within finance, insurance, retail, railroads, utilities, oil and gas. They own companies like Geico, Fruit of the Loom, big investments in Bank of America, American Express, Coca-Cola, Chevron, Moody's, Occidental Petroleum, and so on and so forth. And these are, of course, just giant companies that are not likely to go under anytime soon, and many of them pay big dividends too, which Berkshire usually collects much higher yields on because of either a low cost basis that they've held on to for decades, like in the case of Coca-Cola, or because of preferred shares, like in the case of Occidental Petroleum. Either way, though, it helps keep their sales and profits pouring in year after year while they continue to pile up what is one of the absolute biggest cash reserves in the entire world out there at currently over $340 billion, which they can, of course, then use for a rainy day, especially during an economic downturn or a recession. They could even make strategic acquisitions, which they have done in the past, while other companies may be going under left and right. However, while Berkshire is a very large and reliable conglomerate, and I will grant you that, in my opinion, it's just a fairly boring one too, though. And I don't like how they don't have a whole lot of exposure to high flying tech and AI companies, other than Apple, of course, which to be fair is their largest holding of all. But Apple also happens to be, in my opinion, probably the most boring of all the tech giants out there, too. Apple is a cash cow, though, so I totally understand why Buffett likes them so much. And you look out to next year, Buffett will be retired by then, which I actually think will lead to greater tech investments too, because of how much I feel Buffett was probably stuck a little bit in the past. Maybe a shakeup in management will be good for Berkshire over the longer term. So overall, I am okay with the choice here. I do think the valuation is a little rich, though, over 100% more expensive than the sector on a forward PE. But who am I to judge a stock that seems to always perform very well long term? I will give it a pretty high ranking here for now at number 2, even though it's not a stock that I own myself. I would probably have gone with something like Amazon or Google instead as my low risk option, but I think this one is not a bad alternative either. All right, moving on to pick number 2 for the medium risk option. Grok actually went with one of my absolute favorites in Alphabet, otherwise known as Google, ticker symbol GOOGL, which had this to say about it. For brand strength, Alphabet's Google brand dominates search, advertising, and cloud services, with billions of daily users relying on products like YouTube and Android. This creates a moat through network effects and data advantages, making it a household name synonymous with innovation. Its global reach extends to AI and hardware, reinforcing trust among consumers and enterprises. For valuation, it says trading at approximately 244 with a trailing P of 26, forward P of 23. It appears fairly priced for a tech leader with consistent profitability. The $2.97 trillion market cap reflects its scale, but PEG ratio around 1.7 suggests value relative to expected growth. This avoids the extremes seen in more speculative tech stocks. For future growth potential, it says investments in AI via Google Cloud, Vertex AI position it for expansion in enterprise solutions and advertising. Projections indicate revenue growth from cloud computing and autonomous tech, potentially accelerating in 2026 with economic upticks. Its international diversification supports sustained 10 to 15% annual growth in key segments. And for summary, it says categorized as medium risk because of exposure to tech sector fluctuations and regulatory pressures, balanced by its established revenue streams and lower volatility than pure growth plays. And yeah, I almost entirely agree here with everything that Grok had to say. The company is insanely strong. It's doing over 350 billion in sales, 100 billion in profits, and it's still growing at big double-digit rates regardless of that. They have incredibly strong businesses, like Grok mentioned. There's search, cloud, YouTube, Android, Chrome, Gmail, Maps, and the list goes on. They have future growth potential, and not just all of those businesses too, but also in AI, Gemini, Waymo, quantum computing, and the list goes on there too. Yet despite the stock climbing to record highs along with the market, they only trade for about the same PEG as the sector according to Seeking Alpha. So I actually think that it's still a great pickup even here, as long as you're thinking about it long term. And I would have actually chosen them as the lower risk option before going with Berkshire too. But I'll definitely rank them the highest for now at number 1. I think anyone that doesn't already have at least some exposure to Google in their portfolio is probably making a mistake for the long term. I think it should really be in everyone's portfolio at this point. All right, now for the high risk option, to be honest, I was kind of hoping that Grok would give us a little bit of a lesser known company, maybe a little more of a speculative type of stock. But instead, it actually went with what is one of the absolute hottest and most popular names in the market right now, and went with Palantir, ticker symbol PLTR. Having this to say about it, for brand strength, Palantir has built a strong niche in data analytics and AI for governments and enterprises, known for tools like Gotham and Foundry that handle complex datasets. Its association with high profile clients, including intelligence agencies, enhances its reputation for security and innovation. This brand is gaining traction in commercial sectors, appealing to data driven organizations. For valuation, it says price near 183 with a high trailing P of 631 but forward P of 217. It reflects aggressive growth expectations rather than current earnings. While elevated, the $434 billion market cap is supported by rising revenues, making it accessible for long-term believers. Compared to peers, it trades at a premium, but with justification from AI momentum. And for future growth potential, it says expansion of its AI platform and commercial contracts could drive significant revenue increases, with analysts eyeing 20 to 30% growth in 2026 from defense and healthcare. Partnerships and R&D in large language models position it for broader adoption. Long term, its focus on mission critical software suggests compounding opportunities in a data centric world. And then for summary, it says categorized as high risk owing to its extreme valuation multiples, stock price volatility, e.g., 342% 1 year returns, and dependence on emerging AI trends that could face setbacks. Okay, so like I said, I was hoping Grok would give us a little bit more of like an under the radar type of pick here, but I do still like this one too. In fact, Palantir is one of my largest holdings for a reason, which I'm also up a huge amount on, as anyone would be after the stock has skyrocketed by over 1,700% in just the past 5 years alone. But it's up for very good reason, as they are quickly becoming one of the most important AI companies for businesses and the government, with new giant contracts being awarded to them seemingly all the time, which is leading to high growth and margins. Last quarter, for example, they closed another 157 new deals worth at least $1 million each. They're also creating new solutions all the time that should keep that momentum flowing, like with their Warp Speed platform that uses AI to help companies improve their manufacturing efficiencies, which is hugely crucial, especially right now, as we all know, in the face of higher tariffs and factory relocations and all the chaos and mess that's going on with all of that stuff too. The valuation is very rich, I will definitely grant you that, but at a market cap of less than $500 billion, I actually think that they still have more room to grow. In fact, I think they'll easily cross the $1 trillion mark over the next, I'd say, like 5 to 10 years, especially given their standing on the Rule of 40, which is a valuation metric that is heavily used in the software as a service industry. Basically states if your revenue growth and profit margin together equal more than 40%, then the company is performing very well. Well, in the case of Palantir, not only has it skyrocketed from 46% to a mind-blowing 94%, nearly doubling in less than 2 years, but it's also much higher than similar companies too, without a single enterprise software company that is generating over $1 billion in sales, sitting higher than even 80%. And of the 25 largest market cap companies, only Nvidia ranks higher than Palantir, who, by the way, happens to be worth more than $4.5 trillion right now. All of this to say that I just think Palantir is a premium company that is actually earning that premium valuation through flawless execution. Now I'm going to rank them at number 2 because of it, while pushing Berkshire down one spot so I can fit it in. All right, guys, we are now down to the final 2 stocks. These are, of course, going to be the dividend paying options. And for the first of those, Grok actually decided to go with an oil and gas giant in Chevron, ticker symbol CVX. Having this to say about it, for brand strength, as a major integrated energy company, Chevron is recognized for its global operations in oil, gas, and renewables, the legacy since 1879. Its commitment to safety and sustainability bolsters trust among stakeholders. The brand's scale in upstream and downstream activities make it a staple in energy portfolios. For valuation, is set at about 153 with a trailing PE of 19, forward PE of 16. It offers value in the energy sector amid fluctuating oil prices. The 300 billion market cap and low beta of zero point 0.8 indicates stability without overvaluation. This pricing accounts for cyclical risks while highlighting strong cash flows. And then for future growth, says with focus on carbon capture and renewable fuels, Chevron is adopting to energy transitions, potentially boosting growth in 2026. Rising global demand and acquisitions could enhance production. Analysts see steady EPS growth supported by leveraged free cash flow of 14.4 billion. And then for summary, it says a good dividend option thanks to its 4.4% yield, consistent payout history, and ability to generate steady cash from core operations, even in volatile markets. Okay, so a couple things here. First of all, I'm not the biggest fan of oil and gas stocks. I've said this before. I just tend to prefer names with a little more renewables exposure, like NextEra Energy or even Duke Energy, both of which also pay attractive dividends, and I like how they're investing a bit more heavily in nuclear as well. But if I was specifically looking for a more pure play oil and gas giant with maybe a small but definitely growing presence in renewables, I would probably go with Chevron. I think it's a pretty solid option there, as they are not only the second largest producer in America, helping them generate around 200 billion in sales per year, but those giant financials that they make, from fossil fuels also allows them to now invest in renewables and carbon reducing technologies like they are with carbon capture, as Grok mentioned, which is a market that is projected to be worth trillions of dollars long term. Now, the stock has also been fairly suppressed recently, only up around 60% in the past 10 years, and that's leaving it with a decent valuation and a strong dividend. So I do kind of like it here, but I would say just not as much as the other picks that we've seen so far. So just by default, I am going to have to rank them lower at number 4, even though it's not a bad option, I would say. All right, final stock, guys. Coming in at number 5, the other dividend payer, Grok actually went with a stock that I do already own myself in Verizon, ticker symbol VZ, which I had this to say about it. So for brand strength, Verizon leads in US telecom with brands like Verizon Wireless and Fios, known for reliable networks and customer service. Its investments in 5G and Internet of Things build a forward-looking image. The strength that attracts both consumer and business clients globally. For valuation, trading around $41 with a trailing P of 10, forward P of 9, it's undervalued relative to peers, offering a bargain entry. The 174 billion market cap and low beta of 0.37 reflects defensive qualities. This low multiple stems from mature operations but supports income focus. For future growth, says expansion in fixed wireless and enterprise services could drive modest growth, with 5G adoption accelerating in 2026. Revenue from Internet of Things and cybersecurity adds diversification. Long term, its infrastructure positions it for steady 3 to 5% annual growth in a connected economy. And then for summary, it says a good dividend option due to its high 6.7% yield, reliable quarterly payments, and strong free cash flow, almost 18 billion to sustain distribution over time. Well, again, this is a stock that I do own myself too, so obviously I'm going to agree with most of what Grok had to say about it, but I'll just add to that one of the main reasons why I've chosen to invest in Verizon is because I just see the telecommunications market as a cash cow that is dominated by essentially a triopoly of Verizon, AT&T, and T-Mobile. And I just think Verizon is the best among them, with the most market share, by far the most quality of service awards, not even close, more profit too, and still a cheaper PE ratio, and an even bigger dividend as well. Now for the cons though, they do have a ton of debt, and they are typically very low growth. Plus the stock price is even negative over the past 10 years, so it has not been a great performer thus far. But while it may not be as exciting as Palantir or as safe as Google, I do think that it's a strong value dividend play with a lot of turnaround potential. And for that reason, I would still rank them at number 3 and above the other 2 stocks that are right under them. But yeah, there you have it, guys. these are my rankings here. And to be honest, I don't really see much of an issue with the picks that Grok gave us. I do think it played it fairly safe, sticking with some of the most well-known companies in the market, but that's not necessarily a bad thing, nor is it Grok's fault. It still followed our clear directions, and for the most part, I think it gave us some overall decent picks. I would like to ask it though for some under the radar stocks in the future. So let me know if you'd like to see a video of that in the future. I think that would be a little bit more of an interesting way to have Grok give us some names that maybe we haven't heard of or we're not paying close attention to, and then we could research them a little further ourselves. But either way, I hope that you enjoyed this video. Let me know your own thoughts down below too. If you like the picks by Grok here, do you own any of these stocks? And do you agree with my rankings of them? But either way, I hope you're all doing well, my friends. And thanks for stopping by. And I will catch you in the next one. All right, take care, everybody. Bye-bye.